Yo, yo. Here we go. Let's see, everything looking good? Yes, yeah, all right. Purple tie. All right, waiting for everybody to join. Single file, let everybody get in. Felt like tacos, so I moved Taco Tuesday up to Monday, and I might double dip tomorrow. Crazy stuff. Let's see, what's the latest in the finance news? Dun, 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 dun. Market ripped. That's nice. Looking to end month on an upbeat note. Ooh, government shutdown. Watch out. That's on the docket. I always love the weird, like the super weird articles that you see on the stock app. They used oil from your French fry order. The used oil from your French fry order may be fueling your next flight. Okay, that's good to know. Boom. All right. Yeah, you've got questions. Hopefully, I've got answers. Yes. Fire away. So many faces. And I've become aware of the fact that there's like a limit with how much you can type. So if you have something like really long, it comes in pieces. So just be cognizant of that if you have a bunch of questions. So yeah, there was actually a company that I had bought. I don't know if I still have it on the stock app. I might have gotten, it was like clean. It was called like Clean Energy, something like that. But they basically recycled, Clean Energy Fuels. I think this was it. They recycled, was this it? No. They recycled French fry oil. And yeah, because like used French fry oil still has power, right? It still has BTUs in it. But yeah, they got bought out. Oh, here come the questions. Hey, Cooper, what's up, man? Yes, I saw this today as well. Just heard news about the EA LBO. Wanted to hear your thoughts on how you analyze what makes a good LBO candidate and what you think of the deal. So what makes a good LBO candidate is a company that has lots of cash flow, all right, which EA does. Let me actually, I could pull it up on Cap IQ of my 1,000 windows that are open. But you want a lot of cash flow. That's going to be absolutely critical. And we'll be able to see that with EA. You also want predictable cash flow because the whole idea with a leverage buyout is, oh, here it is. The whole idea with a leverage buyout is you want to pay down debt as fast as possible. And by paying down debt as fast as possible, you're going to ultimately increase your exit value, which is going to increase the IRR. So let me share on the screen EA. But yeah, startups are not good LBO candidates. It's usually companies that have a long track record. I mean, geez, I remember, playing NHL 94 EA Sports when I was growing up, where you could like knock the guy through the glass and get into fights. Actually, I think 93 was the one you could get into fights. I'm talking about Sega Genesis. I'm talking about like real old. But also all the hockey that I played on PlayStation, that was all EA Sports. EA Sports, it's in the game. So if we look at EA here, you see not huge revenue growth, right? So, 73, 55, 79, under 10% revenue growth. The key though is bam, right here, the free cash flow. So you look at the free cash flow, I mean, you're talking about a free cash flow conversion of 25%. 25% of revenue becomes free cash flow. That's insane. And not a capital intensive business at all. There's no real build out per se. The return on equity, 32.3%. I mean, yeah, this was ripe for a buyout or an LBO. Gross margin, 80%. I mean, that's crazy. So yeah, what makes a good LBO candidate? Lots of cash flow, predictable cash flow. So I mean, you look at this, I mean, this is as predictable as it gets. 2100, 2300, 2500, 2640, 2650. Kind of wanes a little bit on the back end. But I mean, they have a dominant sports franchise in the video game space. So not going away. And, definitely lots of cash flow. The only other thing you'd want to make sure of is that it's not too levered. So let's see the balance sheet. I highly doubt that they're very levered. So they're a March 31st year end. So we got cash, 2.2 billion. And then let's look on the debt side. My guess is they're not terribly levered. Yeah, 1.5. Any short-term debt? Yeah, so they got about 2 billion. 2 billion of debt, and then 2.25 billion of cash. So they're net cash, which is phenomenal. So they got a ton of cash. They could pay off their debt completely. So this is like a very good example of an LBO candidate. And then you see cash from ops, less capex. So yeah, this is a prime candidate for a leverage buyout. So lots of cash flow, predictable cash flow, not very levered, and they check all of those boxes. So yeah, that one's going to be an interesting one to say the least. Okay. All right. I want to prioritize 2 to 3 core stocks for extra buying. Which would you choose today and why? Ooh, I like that. Okay. So I don't want, why am I on full screen view? What I would say would be, first off, you said 2 to 3 core stocks for extra buying. I mean, look, I did the video this past week on Microsoft, and as I figured, it was going to be a womp womp. People want like sexy stocks. People want, the next NVIDIA, the next Tesla. So they're not really keen on, a stock like Microsoft. Microsoft would definitely be up there. Rock solid financials, and it's at a discount. So I would say that would be one. Amazon also has phenomenal financials, good numbers. And you said core, so I'm looking for quality. When you say core, I basically impute that to mean quality. So those two definitely come to mind. Microsoft for sure. So I said Microsoft and Amazon. I mean, look, if you're willing to take some volatility, I don't think it would necessarily be the right play right now. But if you want the one that I think has the most upside potential over the long term, Tesla, that would be the one. I know that's a very heavy tech weighting as a result, but you said 2 to 3 core. I'd say Microsoft for sure. Like, you could say Microsoft, and again, this is not financial advice, check with your advisor, blah, blah, blah. But, my opinion, I mean, look, literally my portfolio, Tesla's number 1, and Microsoft's number 2 in terms of the actual weights. So I'm not telling you something that I wouldn't do myself. So that would be in terms of core. So I would say, yeah, Microsoft definitely. Microsoft, Amazon, Tesla, all good. I mean, Meta is always a good one. It's just impossible to get cheap. It's just like very frustrating. It's very difficult to find at a reasonable price. But yeah, those would be my pieces of advice. So you said you had questions, so I'm assuming that's just the first of several. All right, hold on. I got to pop this on the screen. Always want to highlight everybody. Hey, Professor, it's Juan. What's up, man? Hope all is well. Just wanted to ask, what do you think the 100% pharma tariffs not applying to EU and Japan impact growth of both companies within those countries and not? Um, so I think that's more a function of like cost of medicines. So it's very weird that our pharmaceutical costs are very high here, but they're very low everywhere else. And again, on a relative basis. So what I think the whole logic there is that you don't want to kind of have a dual impact. How like those costs have to come down. There's obviously a whole bunch of lobbying going on and all that stuff. So that would be why I think it's not applying, because anything that we're importing, and again, we have like multinational pharmaceutical firms that are out there, like Roche, which I'm almost positive we mentioned in class. They're Swiss. So anything that's coming from there, if they're sending it direct and not via the US, then that's going to get hit by a tariff. And when you think about it, or like Novo Nordisk with the GLP-1s, like if they're sending them from outside of the US, they're going to get hammered with tariffs. So I understand that. That's more so like healthcare costs than it is, trying to bring down the deficit, because it's tough. You have to look at what people are spending on things like healthcare, and that's one that's a significant cost for most people. So I think the whole logic is you wouldn't want to make it even more onerous than it already is. Yeah, I don't know what happened with my screen. Okay, I noticed the same thing. Pop out view. Back to tab. When I shared my screen, that's where it went wonky. So let me share it again. I'll share the EA Sports, and then I'll see if I can come back to normal. All right, we got that. So it says back to tab. All right, and then stop sharing. Now it's doing the same thing again. When I do full screen view, that's like taking up the entire screen, and then I don't see the chat. So maybe someone could look up Riverside and see why that's happening, because it is definitely annoying. I don't know why that's happening. Just give me one sec, because this is very much annoying me. I'll just do full screen, and then I'll have to add in the chat, I guess. This is picture in picture. Super annoying. All right, I'll get it figured out. Ooh, good one here. VOO versus VTI. Does total market actually matter? I mean, look, if you want exposure outside of the United States, VTI is the way that you're going to be able to get it. I'm a VOO fan myself. And here's the logic. The bulk of these companies are multinationals. So when you really think about it, because they're multinationals, it's like you're getting exposure to the whole entire world. Therefore, I would say it's not going to mean that much in the grand scheme of things. So I would say it's de minimis at best. VTI, you'd be getting exposure to certain companies that like are not domiciled in the United States or are based elsewhere. So that's really the benefit that you'd be getting there. But outside of that, that's the only thing that I would say to that. Personally, VO, I mean, think about it. Like Microsoft, which again I keep referencing because that was the video that I did last week or this past week. It's 50-50, like literally 50% US, 50% international. So it's like half their business is coming from around the world. So therefore you are getting that exposure. So I don't really see any like added benefit with the VTI unless it's a company that is not based in the United States at all or doesn't do business in the United States at all, which is kind of rare. But that would be why you would get VTI as an example. That would be the 2 cents there. Oh, we're back to our friend HHH. And if someone can figure out Riverside, I don't know why this stupid thing is half and half. Do you think HHH stock will get some more recognition tomorrow since Bill Ackman gave more details at the annual shareholder meeting? Yeah, I think that it will definitely get more visibility and recognition. You know, it's a long-term play, just so we're crystal clear. It's definitely a long-term play. So just be cognizant of that. I'll share that, and maybe I'll magically be able to figure out the stupid screen thing. Here, HHH. Yeah, HHH is an interesting one because it's like the base company is not something you would want to like invest in, but it's the whole idea that it's going to be an investment vehicle for Bill Ackman. So I think that's really kind of like the logic there. So if you look, all right, nothing really that impressive from a financial perspective. In fact, a little choppy here. So this is HHH, Howard Hughes Holdings. So you look at the operating cash flow being negative 2020, 2021, kind of makes logical sense. That's like COVID pops up in 22, but then pretty negative in 23, very positive in 24, 25. What they do is they own a bunch of land and they develop it. So that's really kind of their core business. And if you look, there's only 3 analysts that cover the company. Yeah, nobody wants this, right? Revenues going down 18.9%. But again, like these numbers are pretty much for all intents and purposes irrelevant. And I'm not even saying that tongue in cheek. There's 4 analysts that cover the company. They don't even have projections past, if you look to the right there, they don't even have projections past 2027. So it's and you look at these numbers, it's just kind of like bonkers, right? 14, 17, 24. It's like, what? And also there's 4 analysts that cover it. It's at, you know, basically $82 and the range is 80 to 85. So it's pretty obvious with 4 analysts covering them, you know, probably 2 have it at 80, 2 have it at 85, or 1 at 80, 1 at 85, and then 2 at 82.50. So that's kind of what's going on there. But 1.75 outperform. So yeah, if Bill Ackman's presenting tomorrow, I would not be surprised in the least if he were going to opine on that. This green thing is super annoying. I don't know why this is. It was when I shared my screen and then I popped out of it. It cut it in half. Don't know why. All right, sweet. All right, so big one here from Anderson. Some time ago, I commented on comparing Costco's PE to that of NVIDIA's, and you said not to do so because they aren't in the same industry. But I see Tom Lee comparing these 2 companies a few days ago. Well, good for Tom Lee. He was saying NVIDIA, high growth stock, trades at a lower valuation than some defensive consumer staples stocks, such as Walmart and Costco. All right, so let me clarify my admonishment there. When you're comparing 2 companies, you want it to be as apples to apples as possible. So what you would want, ideally, is a real estate company to a real estate company, a tech company to a tech company, a consumer products company to a consumer products company. I see what he's saying there, but it's not valid, and I'll tell you why. So there are a lot of companies that don't trade on earnings because they end up having depreciation and amortization. So the like actual numbers are not falling to the bottom. So if you were to compare a tech company to like a telecommunications company, telecommunications is like way more capital intensive. So on a price to earnings basis, if the telecom company even has earnings, the telecom company is going to show at being like a massive premium. So, but it's apples and oranges. It doesn't make any logical sense. So I somewhat see the logic if all you're looking at, I'm assuming he was using the PE ratio. So I would say, like, if his logic is like, this is trading at so much higher of a PE ratio, it's like, okay, there are companies that have a 1 cent earning per share. So it's like the PE ratio is irrelevant. I would be more interested in something like price to sales. Let's go see what Tommy Boy would find about that. Let's go check. I'm curious. All right, so let's go see. All right, So here we go, yo. So we go to multiples, and we're going to look up NVIDIA. I'm not going to bet my life, but I'm going to bet something pretty significant that NVIDIA trades at a higher revenue multiple than Costco. Okay. So let's just look, friends. 26.5. Just put that number in your brain. 26.5. Okay. And then let's look at Costco. 1.45. Ken's right, Tom Lee's wrong. So what Tom Lee is doing is he's looking at the wrong metric. And I know what you're thinking, like, oh, but it's Tom Lee, the Tom Lee. Here's what Tom Lee's looking at. Tom Lee's probably looking at price to earnings, okay? Which again, it's an apples and oranges comparison because it's completely different business models. So depending on what multiple you're looking at, NVIDIA is trading at 26.5 times sales, and Costco is trading at 1.45 times sales. Let's call it 1.5 amongst friends. So that would mean, based on Tom's logic, NVIDIA is super overvalued relative to Costco. Again, why are you comparing these companies on earnings? Like it makes like no logical sense at all whatsoever. So like what he's doing makes no fundamental financial sense is the punchline. It's not how you would compare a consumer staples company effectively, or you could call it a consumer discretionary company, and a tech company. Because then what you would do is your whole portfolio would be tech companies and you wouldn't own anything but tech. So you'd get growth, but you wouldn't have a solid portfolio from like a valuation perspective. So it's an apples and oranges comparison is the punchline there. So not really a huge fan of the logic. And we still have the half and half. Hopefully that makes sense, Anderson. It's an apples and oranges comparison because you're looking at different different underlying metrics. Hey Ken, look up a company Fortescue in Australia. Probably won't invest myself, but definitely an interesting company. Fortescue. Okay. And Anderson, let me know that makes sense, because I'm happy to go deeper. Fortescue. Here it is. Let's see what Fortescue does. Okay, looks cheap on a multiples basis, that's for sure. All right, let's see what they do. Tear sheet, bam. Exploration, development, production, processing, and sale of iron ore. Okay. Oh, it also explores for copper and lithium. I'm guessing that's the play. And rare earth. Okay, we're listening now. It owns and operates rail and port facilities. Okay, this is I've noticed this with like international companies. They're like so oddly diversified. They focus on producing green energy, green hydrogen, derivatives comprising of green ammonia. Now it's like, what the heck is going on? It's like, it's a mining company. Nope. It's a specialty chemicals company. Nope. It's a green energy company. It's like, what is it? What I'd be curious about here is to know what percentage, and I don't think we'd be able to get it from here, but what percentage of their revenues come from those different sources. So let's see if they'll break it out like that. Not key stats. Here, segments. Let's see what they say for segments. Okay, we got the answer. Metals, energy, corporate, iron ore, mining of iron ore. So I guess they got out of the mining of iron ore business, as well as the iron ore business. So now they're just metals and energy. And I'm guessing those metals are copper and lithium. And the energy seems to be like a very, very small amount. Decent amount of EBITDA. The energy business is completely unprofitable. It's just like eating away at all the goodness that they're producing with the metals business. I don't understand the logic of the energy business. I guess lithium, they're maybe doing lithium ion batteries. Interesting. I'd have to like obviously dig deeper into it, but it seems interesting. It's so funny, like over time you'll come across all these like crazy companies and it's just like, what the heck? Like, I'd love to like know the evolution of this company because it just sounds crazy. All right, let's see if I can pull the tab back over to here. Now, bring the call back. All right, that's better. Okay, let's see. You're all right. You did have a bunch of questions. What 3 to 5 non-core would you build around for the next 10 years? Woo. 10 years. See, I like that because, for example, like Lululemon, I would not invest for 10 years. Like, that's not one I would invest for 10 years. That's one that I think would be a decent trade. 10 years. I mean, if you consider Tesla non-core, I would definitely rock Tesla for 10 years. I think that's like a total no-brainer. Let me see if I can get out of this and go back to like a full screen. Nope, half. So I'm just going to look at like what I have covered in the past. So SoundHound, honestly, SoundHound's going to get bought out by somebody. That would be non-core. Rivian, I'd say for 10 years. That'll be good for 10 years. That's 2. How many do we need? 3 to 5. SoFi's not cheap right now. But that definitely has like a massive total addressable market. So I'll go with those 3. And I mean, it's hard to go wrong with the Mag 7, honestly, because, Celsius is another one. I don't know if Celsius is going to have a 10-year runway. That's the only thing that I would say with Celsius. Like, I feel like maybe a 5-year runway, but I think Pepsi's going to buy them out at some point. And there's nothing wrong with owning a company that's going to eventually get bought out. Like, there's nothing wrong with that. Yeah, so I don't think you asked about this last week. Somebody else asked about it. Thoughts on Webull. I've been digging into it. There was that and TTD, the trade desk. I mean, let me go bull. Yeah, someone brought it up last week. This is helpful, by the way, because when I do like last week's video on Microsoft, I might as well have like thrown it into the Grand Canyon. Nobody cares about it. It's a phenomenal company. It's a fantastic investment. Nobody cares. So it's like if you do, you have to be careful because like some companies that you cover, either they're so big nobody cares about them or they're so small nobody knows about them. So you have to kind of be right in the middle. So here's Webull. I want to see what the tear sheet says. Yeah, digital investment platform. I guess the real investment thesis here is they have more of an international focus. But let's go check that out, actually. I'm curious. Segments. What the actual breakdown is. All right, it just says brokerage. And the problem is, like, there's just so much competition. Like, every time I cover Coinbase, it's like there's like a gazillion competitors. So really the question would be like kicking it back to everybody else. It's like, okay, like why would you use Webull as opposed to all the other options out there? You see that, trailing 12 months, big growth, and it's predicted to grow more in the future. Let me see some of the returns. Margins are garbage on the net income side. Not really good on this. I mean, they don't even have a breakdown of EBITDA. Let's see key stats. No, that is the key stats. I mean, do they even have positive EBITDA? They don't even report EBITDA. I mean, in essence, operating income is EBITDA. So minus 14 and then 8. This is the type of company that like I'd be okay missing out on like the first bit of upside in order to know that they're going to like actually be in business in the future. I'm curious to know if they have a bunch of leverage. Hopefully the answer is no. So cash and securities segregated. I wonder if they have a breakout of this because they're probably investing in crypto is my guess. But let's just add that together. So you're talking about like 1.6 billion there on the debt side. Okay, 100. That's not much. They got rid of a convert. That's good. It's interesting. What you have to think about with some of these businesses is the actual business model. Like that's the challenge with a lot of this stuff is what is the actual business model? Like what's the long-term game plan for the company? Let's see if I do escape. No, this stupid screen cut in half. Pissing me off. Okay, so we're back to Fortescue. Sounds French. Iron ore mining, but they're doing a ton of investments in renewable energy. The renewable energy business we saw is a complete dumpster fire, like horrific returns. Okay, 95% iron ore, 5% of the rest. Yeah, I'd need to understand because it's like in that segment breakdown, they show like most of it is not iron ore any longer. So I'm curious. Oh, Pratyushin the Hizzy, what up? Interesting. Oh boy. So, truth be told, I really like JOBY too. It's also ironically one of my larger holdings, but I bought it. I'm not joking. I bought it at like $4, and I bought it. If you've been on the previous live streams, I talked about 100 Baggers by Chris Mayer, and that was my whole logic was they're going to end up winning the EV toll race, you could call it, and it like 4x'd. So that's one that of the space, they definitely have the ability. They're better than Archer Aviation with zero revenues. Like that one, I still can't understand for the life of me. But I would say that would be another one that you could add in the non-core space. But just understand, like, it's kind of I'm not being like silly, but it's what you'd call a flyer. Like, might work out, might not. But that's one that you just hold. You check it out every so often. I literally have more people tell me about JOBY than like I pay attention to it. They're like, "Oh, have you seen JOBY?" And that's when I look and I'm like, "Oh my gosh, this is just it's getting more insane by like the day. It's wild." But yeah, it's definitely got a big following now recently. Interesting. I use Webull because I like the user interface, but I only use it for my most volatile holdings. Everything I'm buying for 20 years I hold in Schwab, but my Starbucks shorts and some other small holds are there. That's interesting. It's the user interface. Okay. So you could argue if Webull has a superior UI, that would be a potential rationale. Hey, I got it back. Dude, that was annoying me so much. All right, so is layouts. Now we got it figured out. I'm back, y'all. I'm back. Look at this. Look at this screen. Freaking rectangles. Hell yeah. That's interesting. You know what? Some of these, honestly, like some of this stuff, it goes beyond just pure financials. You have to understand, like, what is the business? What is their competitive advantage? So if you're literally using it for the user interface, that's a good reason, because it's ultimately like a very low barrier to entry, highly commoditized product like crypto brokerage. There's no real like competitive advantage there per se. But now you've got me intrigued. I'm going to look a little deeper. You previously mentioned that you wait until the bottom is set when the stock is going up. Would you consider LULU bottomed out? And if not, what else do you consider? Yeah, it appears that it did, because once I said that, somebody on the channel commented. They were like a real wise ass, and they were like, you said you wait for it to bottom out. I guess I got to keep waiting because it keeps going down and down and down. It's like, dude, you live your own life, bro. Like, I didn't tell you what to do and everything. But how do you know something bottomed out? It's pretty easy. It's what we call post rather than ex ante. You can't tell if something's bottomed out like on the way down. The only way you would know is like it's gone back up and you're like, well, I guess it bottomed out there. So yeah, it looks as though Lulu has. I'm actually curious. I don't know the next time that they report, but that would be interesting because I know like Constellation report. Yeah, of course. So missed the bottom. Ken missed the bottom on Lulu. Yeah, it looks as though it has. You have to give it a little bit of time, though. Let's see, 1 month. I would say, if the trend over like more than a month is going that way, it's a pretty good indicator. It's definitely on a ton of investors' radar. So I would say that that's most likely. Like, let's put it this way: are you going to be able to get if you're waiting to buy Lulu under 160? Not going to happen. Like that's my my 2 cents on that. So I would say, yeah, it appears that has bottomed out. But again, that's more like technical analysis, which I absolutely hate with an undying passion. I'm all about fundamentals, numbers, cash flows. But the reality is, like, you could just use the power of observation and tell, yeah, this thing has bottomed out. It's on its way back up. So yeah, I think it has for anybody that's bought in, because I know a few of you have like reached out previously saying like, hey, what do you think about Lulu? Because you're looking at like dollar cost average getting to more. Some people have like over a 200 cost basis, but that's one I like legitimately think sometime in 2026 will be, touching 300 if not above, because it wasn't that long ago that it was at that level. What is important to include in a thank you note via LinkedIn to someone who interviewed me? Via LinkedIn. I would say first, I wouldn't go via LinkedIn if you can avoid it. If you have access to their email, I would be appreciative of the opportunity and thankful. I would definitely try to focus on not LinkedIn. LinkedIn to me is kind of like social media, but corporate. So I would avoid LinkedIn. I would send an email. Now, if you really want the position, I would send a handwritten thank you note. I know that's like old school, crazy. Fun fact, good friend of mine who's an executive, like very super successful, he said he literally has hired every single person that sent a handwritten thank you note. And I was like, how many people have done it? And he was like, I can count on one hand. I was like, oh. But usually what you want to do with the thank you note is reference something in the interview that, you vibed on, or a commonality, like I really enjoyed blah, but you want to keep it very like succinct and to the point. Looking forward to hearing back from you, something like that. So it's kind of like, tell me what you're going to tell me, tell me what you told me. Thank you so much for the opportunity to interview at your firm. I think it's a fantastic opportunity. Something unique that happened in the interview, like that you appreciated, what have you, could be about the firm itself. And then follow it up with, look forward to hearing from you. Best or thanks, Ken. Boom. That would be the way that I would do it. Keep it short and sweet. Don't write a novel. You just want the person to be like, okay, they paid attention, they were thankful and appreciative. But that's the big thing you want is that appreciation. That's key. All right, sweet. Here we go. At what point would you consider Celsius overvalued? I know it's risen a lot lately. Well, when I did the model last time, it was an intrinsic value of 70. So I think it was, let's see, just take 70 divided by 1.2, 58.33. So it's still at a 20% discount. Whenever you get the intrinsic value, just divide by 1.2 and that will give you. So $58.33 is a 20% discount. It closed at 56.90. So definitely not overvalued. The problem is when you're looking at Celsius, you're looking at it based on where it's come from. So you're like, oh my gosh, it's gone up so much. But like, let's step back and think about what's happened. They bought their nearest competitor who was basically eating their lunch, which was Alani Nu. They did that. Then they got an additional investment from Pepsi, which then Pepsi took back and gave them Rockstar North America. And then Alani Nu got added to the Pepsi distribution network. Those are four pretty massive things, and it definitely corresponds to the increase in value. So last time we looked at it, which wasn't that long ago, 70 was the intrinsic value. So if you do 70 divided by 1.2, you get 58.33. So it's still at a 20% discount, greater than 20% discount. What's the most common portfolio mistake you see students or beginners make? Trading rather than investing. Those are, I would say, the most common mistakes for a beginner. The stock goes down, you're like, oh my gosh, and you sell it. Like, look at Lululemon, right? If you're not disciplined and focused on the long term, you might have pulled the plug and be like, I can't take it anymore. And that's human nature. And that's one of the most difficult things with investing. So if you want to get like a good value, yeah, you're going to have to dollar cost average into stuff. The biggest complaint with value investing is I got in too early. But the other biggest complaint is I also sold too early. So a lot of investors will complain. Those are the three main complaints. Okay. I got in too early. I didn't buy enough. I sold too early. Those are the three biggest complaints of professional investors. So I would say taking a trading approach rather than an investing approach. I would advise, kind of like old school Warren Buffett, Charlie Munger, if you're going to buy a stock, your thought should be, I'm going to own this for 10 to 20 years, period. And the crazy thing is, I would advise going backwards. Take some of the stocks that, like, literally right now today, you're like, I wish I had this in my portfolio, whatever it is. Maybe NVIDIA. Go backwards. At what point, be honest, would you have sold? Because there's a lot of people that did that, whether it's NVIDIA, Tesla, like the way that you're going to get the best return is through holding. Now, I know what the follow-up is going to be. Well, how do I know when to sell? So like when there's an actual deterioration in fundamentals, that is when you consider selling. Not just it's overvalued. Like from a portfolio management perspective, a stock being overvalued, if like it's still a phenomenal company, you trim it. You reduce the portfolio exposure. So look at Tesla. It hit 488 in November. All right. Trim it because it's overvalued, but you don't sell the whole thing. You trim it because who knows, it could go to 550, 600. You also have to remember professional portfolio managers are looking at things on like a quarterly basis. So it's a little bit different. But I would say taking a trading approach to investing, that is the kiss of death. But this is also why it's important to learn how to value companies. And most people don't know how to do that. So they just look at things or will listen to people like Tom Lee talking about this bananas nonsense about, Costco is overvalued relative to NVIDIA. Like, it's just like, like the logic makes zero sense at all whatsoever. Like he's focusing on the wrong metric in that scenario. We were talking about this earlier, but I would say taking a trading mindset towards investing, total kiss of death. What I would advise everybody to do starting out, VOO, dollar cost average into VOO. Like if you frankly, like if you want the real talk, if you haven't maxed out your retirement in VOO, you shouldn't even be thinking about individual stocks. And at the very least, if you're on the younger side, 7,000 into a Roth IRA VOO, and then you could talk about individual stocks outside of that. But ideally, you want 7,000 in the Roth, the 23,500 in the 401k, and then you can talk about individual stocks. Now, I know that's a heavy lift. I get it. But that's the real talk. I know that was a classic Ken tangent, but at least you know my opinion. Have you seen Alibaba lately? Yes, it's been absolutely ridiculous. Now China is investable. Love the rationale. Yeah, that was another one that was kind of interesting because when I did the video, I got like weird vitriol from people like, Alibaba's a scam. It's like, all right, then don't invest in it. I don't care. But obviously it worked out. So that's another one. Someone was telling me the other day, they're like, have you actually looked at your videos and the performance? It's actually pretty good. And I'm like, I don't know how I could articulate it though. You know what I mean? Like I would just say like, I said buy at this point and now it's way higher. Like You can't do it as a portfolio. I can't say like, I got a 50% return because every one is kind of separate. But I guess I could do like average return, something like that. But someone was telling me that the other day. I'm open to ideas. Hey Ken, I was wondering if you could share more about your experience taking the CFA Level 1 exam and some best practices. Absolutely. So everybody pay close attention here because this will be relevant for anybody, whether you're taking or thinking of taking or planning on taking CFA Level 1. Okay. So there's a few key pieces of advice that are absolutely critical. First, the rule of thumb is it's going to take 300 hours of studying to pass the exam. So you say, oh, I'll study an hour a day. Here's the problem with that. That's 300 days, which is 10 months. The stuff that you studied at the beginning is going to be stale by the end. So you're like, okay, I'll study 2 hours a day. All right, cool. We're still talking about 5 months. So it still stands to reason that that initial information is going to become stale. So obviously you're like, dude, what do I do then? What I would say is 2 to 3 hours a day is a good amount of studying. Set aside a full 6 months. Then what you also want to do is a month before sitting for the exam, just take practice exams. That's all you want to do. Practice exams, practice exams, practice exams. Absolutely critical. When you're taking the practice exams, mimic the test environment. Be someplace quiet, no phone, put in earplugs, and do it in 3-hour increments because the first half is 3 hours, the second half is 3 hours. So just mimic the total test environment. Time yourself, make sure you're staying on top of things, and then look at the areas where you scored below 80 and then go back and revisit that content. That's what you would want to do. Also, I'm not a huge fan of just reading through the CFA materials. They're so freaking boring and dry. It's like reading the dictionary, although I have read the dictionary before. That's a little bit more interesting. No joke. So there are multiple testing providers out there. I'm a big fan. I get nothing for this, but Wiley Efficient Learning, they got bought out by a third party. The thing I liked about that was they focused on the LOS, which are the learning outcome statements, which is what you're going to get tested on, and they drew everything on a whiteboard. So I personally like that a lot. Another little life hack, this one's for test day. So what's interesting is you're allowed to have a financial calculator. Because I'm a Dorkosaurus, I have multiple financial calculators in my backpack, which is with me at all times. So hold on. Such a dork. All right, so I have the Texas Instruments BA2 Plus, and then I also have like the business one. This is like the more up-to-date BA2 Plus. 2 calculators. Now I know what you're thinking. Hey Ken, why 2 calculators? So this was actually brought up to me by someone, and I was like, oh my gosh, that's genius. So on the day of the exam, they say, bring a calculator, bring batteries to replace, and screwdrivers, okay? So someone said to me, they're like, dude, if the calculator breaks, you're already like under stress and pressure. Do you really want to be like unscrewing the calculator? I was like, no, but you know, it is what it is. They're like, dude, just bring 2 calculators. I was like, so 2 calculators, replace the battery the night before. Don't even waste your time bringing the stupid screwdrivers. If both calculators break, first off, statistically, the chance that one calculator would break is infinitesimally small. If both calculators break, just walk out of the exam. It's not your day. It's not meant to be. So let me go back up because, yeah, no, this is the BA2 Plus. You want to get like the simplest, dumbest calculator possible. Like you can have this one. So this is the BA2 Plus. This is the old school one, and I showed the newer one. But there's that, and then there's like the Hewlett Packard calculator, which I hate. They call it reverse Polish because you have to enter everything in opposite. But yeah, so that would be the thing. And also the end of chapter questions for the CFA in the curriculum are not anything like what you're actually going to see on the exam. Because the exam, they're multiple choice questions on level 1, and you have 3 answers. You could always eliminate one, and then like you always narrow it down to 2. So that's what happens with that. And you can ask more follow-ups because I was all over the place there. All right. Question of opportunity. Yes. Um, Pete, what's going on, man? You more bullish on LULU given they are now partnered with Amex Platinum credit card. So every quarter, Amex is giving $75 of credits to all users to buy on Lululemon. Wow. Um, I mean, I think people that buy Lululemon are already in that kind of like Amex class of buyer. I think all that's going to do is incentivize them to like buy more and buy more frequently. I don't know how much of an actual financial impact it would have, but actually, Pratush brought it up earlier in the questions. He's like, "Do you think it's bottomed out?" And I would say, like, it looks like it. I don't think we're going to be able to get Lulu below 160. I think that ship has definitely sailed. Um, Hold on. Show on screen. Hey, Ken, you're an individual whose channel is built on understanding value in companies. Yes. What steps would you take on creating a stock pitch, and what questions are you asking yourself when preparing? Excellent question. I think we might have, like, this might sound biased, but I think we might have one of like the better, smarter subscriber bases out there. I know Graham Stephan probably has some Nobel laureates and PhDs, but this is a very good group. So please give yourselves a round of applause. So you want to invert the problem when it comes to a stock pitch, okay? So Charlie Munger and Warren Buffett, the way that they've always approached whether or not they should invest in a stock is find every single reason to not invest. Every single reason. And then if you're still willing to move forward, that's how you know it's a good investment. Okay? So you need to answer every possible counterpoint. And if you can do that with confidence, that would be a sign that you should move forward. But what you really want to do is go macro down to micro. Okay? So you want to kind of figure out, okay, like, and again, everybody's popping stuff into the chat every time we have the live stream, which is cool. But some of them I just kind of say like, not good, not interesting, because it's something that just doesn't have enough of a total addressable market, or they're not going to be able to penetrate the market enough, or there's so many reasons why you could knock it out of the box. And sometimes you'll just knock it out of the box and it's like game over, right? So you want to start like wide end of the funnel and then move down from there. So where are they relative to other competitors in the space? So let's take SoundHound, all right? And I know there's varying opinions on SoundHound. SoundHound is like an N of 1. There's no other SoundHounds. Now you could say, oh, well, companies have voice, recognition technology. Okay, fair. Is there a pure play one? I'm not aware of one. So, that is kind of step one. Also, you want to know that the market that they're in is substantial in size, and they have room to grow into that size. So taking SoundHound as an example, I mean, you think about the applicability of it: cars, restaurants, customer service, hospitality, just a few areas alone. These are massive, hundreds of billions of dollars industries. So it's like if they're able to penetrate that, and they have and can and will, there's a lot of logic to that. Also, you want to know that there's a long runway for the company to grow in the future. So you could find a lot of companies that are cheap that sell like typewriters and beepers, but those are not businesses that are growing. So those are some of like the qualitative things. Now, when I'm actually looking like, okay, I'm going to pull the trigger, I'm going to invest in this company ABC. What I want to do is make sure from a financial perspective, they have solid financials, stable margins, ideally expanding, but at the very least, stable margins. You don't want to see margin compression. Obviously, revenue growth. People get too fixated on that because revenue growth is going to come with some sort of investment side. And if you're growing revenues, but your margins are compressing, which means you're actually getting less profit for every dollar that you make, I'm not really a big fan of that. You want to look at metrics like return on equity and return on invested capital. Warren Buffett's rule of thumb, greater than 15% on return on invested capital is what you really want to use as a benchmark. And like, no joke, rule of 72, how long does it take to double? So when Warren Buffett looks at a company, he wants to know that it's going to have a compounded annual return of 7%. so that it doubles every 10 years. Now, that's him, and he's had a hell of a track record. I think the other thing that people mess up with is they want to get like 100% return. Like when I've done the videos, and we could go, down the list, Celsius, that's up over 100%. Who else? NVIDIA, from the last time I did it, it was at 97, so that's up 100%. SOFI's up over 100%. SoundHound's up well over 100%. So when I look at these, I'm not looking at them as though like I'm only going to consider these if they double. Like I'm just looking at stuff that's at a discount, a 20% discount, and it has that growth path and that growth trajectory. So hopefully that makes sense, but I see a follow-up here, so let me check that. To follow up on that, how does pitching across sectors change your mindset when you're creating a pitch? Healthcare versus TMT. Also good question. So there's different parameters to consider. So TMT, telecom, media, and technology, for those who are not aware, more capital intensive. So in order to stay competitive, you're going to have to spend a decent amount in capital expenditures. So look right now, the Mag 7, the arms race for these data centers. But you could also look at telecommunications companies like 5G, the 5G rollout. Eventually there will be 6G. So it's like you have to be confident that the company you're looking at is going to be able to stay competitive technologically, and they're going to have to invest accordingly. So I wouldn't want a company, we could use an example like Intel, which is very highly levered. Like, how are they going to invest in more technology if they have all this leverage weighing them down? Now, the answer is they got all this money from the government and NVIDIA and this and that. Okay, that's fair. But you want to consider that aspect as well. Healthcare, you want to try to figure out what the niche is. So technically pharma is in healthcare, but I look at like a hospital very differently from a pharmaceutical company. So if you think of pharmaceutical companies, they basically have, a 20-year protection period on whatever drug that they have. So you want to know that there's more drugs coming out in the pipeline that they're going to be producing, that they have really good research and development. But that's very different, for example, from a hospital. Hospital, like, you just need sick people. Or they have some sort of specialization, like the Hospital for Special Surgery, which is near where I'm located, New York, New Jersey area. So those are the types of things that you would have to think about on a sector basis. Like if I were doing energy, like oil and gas, that's 100% contingent and dependent on, commodity prices. So it's very difficult to pitch an idea in that particular industry if you're not cognizant of those prices. So those would be some of the considerations that you'd have to think about. So you have to think about like industry drivers in addition to the individual company catalysts. So it has to be like a combination of the two. And then also, what is the point of the investment that you're making? Are you just trying to get a return? Are you trying to hold something for a long period of time? What is the actual time horizon? Because that's another thing that becomes challenging. If you said to me, like, what's your best idea for the next, year? That's very different than like, what should I hold forever? And like someone was asking earlier, what should I hold for 10 years? Like, that's the right question to ask. But there's a difference between like a dislocation, like a trade. Like I would say Lululemon is not a company that I would plan on holding for 10, 20 years. You just look backwards. It goes like this. It's pretty much, like a sine curve. It's going to go up. It's going to go down. I don't see like long-term compounding there in that instance. But has it pulled back? Yes. Is it at a discount? Yes. That would be something that I would say would be like a 12 to 18 month play. Pete, that should attract folks $100 track pant on Lululemon when they could buy it from Costco for 20. I can almost Amex give me $75 credit a quarter from Lululemon. What's your end of year target for Lulu end of next year? So when I did the video initially, and then they dropped the guidance again, my initial valuation was 305. And then the updated one, which is like draconian, super negative, the whole 9 yards, it's like 210. So I would say realistically, assuming that they don't keep dropping guidance down, it would be somewhere in like the 250 to 300 range. But honestly, I'm going to have to update it as it improves. But I see like realistically, I think LULU is the type of company that could be back to 300 and above in 2026. That's pretty much what I'm anticipating. Ooh, actively studying for CFA. Yay. Does that mean engineering calculators are not allowed? Unfortunately, no. Engineering calculators are not allowed in the CFA. They want like the simplest calculators. Yep. TI-89 is a no-go. So yeah, yeah, buy two calculators definitely. But the BA2 Plus, dude, is like super cheap, and it's like it's such a moronically simple calculator. You know, it's pretty much time value of money. I'm just gonna look it up right now. I'm just curious. BA2 Plus calculator. Yeah, dude, like $30. It's a no-brainer. The one that I have, so the two that I have, one is literally the one that I have from college, and then I got a more updated one. This question came up last week, actually. Do you wish you stayed in industry and became a hedge fund manager or MD at a bank? You definitely would have been killing it at a hedge fund. No, I have no regrets. I actually very much like this a lot more. Also, I think there's way more market potential for what I'm doing in terms of the world versus just, being at a hedge fund crushing it. But maybe one day I'll start a hedge fund and I'll fundraise from people on the channel. It's a thought. But yeah, I really like doing this. I think it's pretty obvious. And I like teaching people, helping people. I wish I had a resource like this when I was starting out. But no regrets, because I see the ultimate potential of what I'm doing, and I think it's way higher than being in industry. And again, I'm still exposed to industry because I run all these training programs, hence the tie and all that jazz. Thoughts on Cooler? Well, my first thought is I like the ticker. I always am fascinated by the ticker symbols. I'm wondering, like, is it a company that actually sells coolers? And I'm probably pronouncing it wrong. It's probably like color. KULR Tech. Hold on. Key stats. Don't worry, I'll share. Sharing is caring. All right, here we go. Off to Cap IQ. Wait for it. All right. So let's see here. Crazy growth historically, big growth in the future. Not profitable. See, this is wah, wah, wah. I mean, they could make all the revenue in the world. Like, if they're not profitable, I could give you the intrinsic value of this company, 0. Unless and until they generate positive EBITDA, they don't have any cash flow. Now let's look at the tear sheet and see what the story is there. Delos and thermal management technologies for electronics, batteries, and other component applications in the U.S. provides lithium-ion battery thermal. I think we might need Cooper to opine here. Automated battery cell screening and test systems, safe case, fiber thermal. I feel like this is something that like you came across through work somehow, Pete. And then I don't know if Cooper has an opinion on it. We usually have some engineering folks. Companies' technologies are used in electric vehicles, energy storage, battery recycling, cloud computing. There we go. Buzzwords. 5G communications. Lithium-ion battery. Okay, interesting. I mean, look, lithium-ion batteries, like period, full stop. Battery technology in general is going to be a very like hot area moving forward. That being said, it is just a slog, like super, super difficult. Here we go again. The stupid. There we go. I fixed it. So I got into batteries when I was bored out of my mind during COVID. So I have a bunch of battery companies that I've tracked for a very long time. One of them was backed by Bill Gates, and it was iron ore and water, and they were able to create effective batteries. Hope I didn't remove it from the list. Wait for it. Oh, did I? No, here we go. GWH ESS Technologies. That that's backed by Bill Gates and a few other big investors, and it's all about battery technology. That company. Um, so yeah, I'm not familiar with Cooler, but battery business is tough. There was one I came across. They focus on recycling of batteries. That is something that I think is very interesting. But again, it's like the scale piece is what's tough. I mean, those batteries in like the electric vehicles are thousands of pounds. Like I don't even know what the hell the process would be to extract that. It's not like you're throwing out a Duracell or something like that. Um, this is an interesting question. With automation accelerating, do you own any robots or industrial automation stocks? I do not. I mean, the closest one would be Tesla, humanoid robots. I would say that is the one that I would be, the most exposed to. But honestly, like I'm a fan of like pure play scalable. So of course, obviously Tesla is not pure play, um, robots. But I'll tell you what, if you throw out some names, I'll take a look at them because I personally don't know of any that are like decent from a financial perspective. Hey, Ken, lately I realize more and more bearish experts and YouTubers tune into bullish since the market keeps going up. Now you could barely hear any bearish sentiment on YouTube. Are you bullish too? Um, I've been selling more than buying due to all kind of bearish people turning into bullish. So you're a contrarian. Um, So remember, the stock market is a leading economic indicator. So the only thing that an increasing stock market means is positive economics. So I always see bullish, bearish stuff on YouTube. Like if I go right now into my YouTube studio and trends, it's all going to be negative stuff. And it's so funny because it's just like scare, like doom content. Here, let's look. Analytics trends. Okay. Here, I'm just gonna like read like what it says. Like YouTube is telling me, like, hey, people might want to watch this garbage. Okay. 1.3 trillion CRE meltdown, commercial real estate meltdown. Sparks bank crisis the Fed can't contain. First off, I don't know who this person is. Like, I'm always leery of listening to somebody that's like a total nobody. Like no basis at all whatsoever. That drives me insane. But like there isn't a 1.3 trillion bank crisis. See, this is the whole thing. It's like to get the click like that. It's like I hate that stuff. His warning: you lose 50% in cash. Strategist: central banks will let inflation run high, erasing 50%. Oh, you're right, Danny. There is a bullish one. Rate cuts ahead. Stocks to benefit. And it's like some chick who looks like she smelled a fart. So like, look, I just try to do good, solid content. The fear mongering stuff that's out there is not one that I'm like a big fan of because it's like that's when you run on that, like you got to stick with that. And I'm generally positive to answer your other question. So yes, I am bullish on the market. I don't find much at a discount. I will tell you that I'm not finding many stocks that are at a discount. Like I want to top off Constellation Brands, dollar cost average into that. LULU, I still haven't started a position because I was waiting for it to bottom. I obviously missed that. But in general, I'm definitely bullish across the board, but I can't find much stuff that's cheap. I will tell you that. I don't find many things that are cheap. As you're going through the exam, I'll go back to my T89. I love being able to pull previous calculations down. Yeah, I mean, you could do it while you're preparing. Ooh, that would be a good idea. That would actually be like a really good like lead magnet. Where you guys end up coming up with ideas and then I hire you to work at the hedge fund that I create from the YouTube channel. It's possible. Anything's possible. Part 1, trying to learn more about credit investing. Ooh, yes. Your channel is helpful in understanding equities, and if I feel good about a company's equity, then I usually feel good about its credit. Hold on, part 2. Because you're higher up in the capital structure. What are the most important metrics, qualitative, quantitative, to feel good about the credit of a more stressed company where you're not so comfortable with equity? Excellent questions. So there are not many people on YouTube that are even quasi interested in credit. Credit is way more difficult to understand than equities. Equities are very like palatable, easy to understand. Now, remember what credit is. So just so everybody's aware, fixed income, think of a bond. So you buy it for 100 cents on the dollar, you get a coupon along the way, you get 100 cents on the dollar back. Now, what happens is sometimes companies go through financial stress, their bonds will trade down. So their bonds won't trade at 100 cents on the dollar. Let's say they trade at 80 cents on the dollar. So now you could buy something at 80 cents and then get par value at the end. Whoa, 20 over 80 is a 25% return. And you get the coupon in the interim. So you're like, this is a no-brainer. No more equities for me, credit. But you might not receive par because the company might go bankrupt. So with credit investing, you're more focused on collateral, seniority, and recovery. Collateral, seniority, and recovery. So it's a very different perspective with credit investing. So the only way that you're going to get those like nice returns are being lower in the cap stack where you have less certainty of recovery. But usually what happens with credit investing, if you're doing it like for profit and you're not like running a fixed income, mutual fund strategy, you really have to look at the credit agreements. So the most successful credit investors typically have a legal background because you have to look at the credit agreements and see what your protection is. That's why nobody does it on YouTube, because you actually have to have a brain. Not that people on YouTube don't have brains. I'm talking about the creators, not the viewers. And then also, I just don't think there would be enough of a market for that. But that's really what you have to focus on. Where you are in the capital structure, the protection, the seniority, the collateral. And then you'd have to be confident that you'd be able to get out of it. Those are the challenges there. But it is a very fascinating area. All right, Cooper knows about Cooler, but not enough to form an opinion. Okay. Okay. So now we've got some of the automation companies: Rockwell, Honeywell, Siemens. Okay. Those are capital intensive businesses. I've come across Danaher's another one. Yep. Okay. So, whoa, deja vu. Yeah, Danaher, I'm a big fan of. What was the other one? Ingersoll Rand Industrial. They're another one. Like, no joke, Danaher and IR Industrial. Okay. Those two companies, what they do is really fascinating. They have a ton of scale. So what they'll do is they'll buy an industrial company knowing that they have way more bargaining power and way more scale, and they'll roll up these companies, and just by virtue of being within their organization, they have more bargaining power with suppliers. So like, you're buying a company and you like automatically know you can increase its value. Those are pretty cool businesses. So yes, I've looked at IR Industrial in depth because I was actually hired by a company to analyze them because they're one of their competitors. And that is a phenomenal business, like a really, really good business. I mean, they just compound like crazy. But yeah, I would say in that space, Ingersoll Rand Industrial and Danaher are like world class, both of them. I have a quick question. If I have enough to cover my Roth IRA for next year, should I invest it all into VOO, or should I dollar cost average? You'd still want a dollar cost average. There's studies out there that are like, throw it all in. But I would say I wouldn't necessarily wait an entire year to dollar cost average into it. Like, no joke, what I do is like, I put the 7, I let it settle, and then, I just pretty much on like down days, I'll push into it. Like, I take, a month to invest in it, VOO. So I would still dollar cost average, just so you could spread your exposure. But again, remember, like when you retire, it's not really going to matter, because whether you bought like here or here or here, it's going to be like way up and to the right. But I still would dollar cost average, just in case, God forbid, like a liberation day happens. So let's say like we were having this conversation in March and you put the whole thing in, and then liberation day happens. You're like, oh man, I wish I had some dry powder. That's kind of the only thing that I would caution against, and why I would dollar cost average, because you never know um, when something like that could happen. Copart is going semi-viral. I'm not familiar with Copart. I guess they're an industrials company, semi-viral. See, this is what I'm going to need from all of you, is to tell me what stocks other people are focused on YouTube, so that I could consider covering them. Because like last week I did Microsoft, and as I thought, algorithms like nobody cares. And it's going to eventually get more and more views, but I get it. Nobody cares. It's the second largest company on planet Earth. But if I cover like some garbage company and everybody's searching for it, it's like it flies. So we're in like a weird spot. We're like slowly but surely approaching about 11,000 subscribers, which, thank you, by the way. I couldn't do this without you, literally. But to get to like 100,000 subscribers, like once you're at 100,000 subscribers, you could do a video on anything, cooler, Copart, and like by virtue of having 100,000 subscribers, if 10% of your viewers watch it, you got 10,000 views, like boom. So like right now, if 10% of viewers watch this, you know, it's like 1,100 views, and it's not even 10% because it takes a while for it to show up in the feeds and stuff. So like I know we talked last week about Webull and TTD. Both of those actually have good search juice. So any ideas that you guys have, feel free to fire them in the chat. And actually, Sandeep did. Tesla seems to be your strong recommendation. Yes. What do you think about the volume sales look like? 7,500 federal credit going away? Not concerned. Many would not buy, I assume. So here's the thing with Tesla. Tesla is actually a technology company that is like masquerading as an EV company. If you look at the growth in their energy storage segment, it is incredible. That is the hidden gem of Tesla. Then when you add, which by the way, this is not reflected in the valuation, when you add in humanoid robots and self-driving cars, that's where it gets stupid. Now, do I think Tesla's at a discount right now? No. You know, if you were buying it in like the mid 200s, that would be the time to get in. One of the things that hopefully you've noticed with Tesla, I've noticed with Tesla, is people like leave it for dead. That's the time to buy. And then when everybody's like, oh my gosh, Tesla, 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 that's the time to stay away. So like Tesla has ripped recently, and now everybody's like, oh, I knew Tesla was going to rip. It's like, okay, did you buy any? It's like, well, no. It's like, okay. So like in the mid 200s, everybody was like so negative, so anti-Tesla. I think the whole thing is with the 7,500 EV credit going away, net, how many people that were buying a Tesla were buying it because of the EV credit? I don't think many. A Prius? Yes, I think it will have a bigger impact on Prius buyers. But I don't think the typical Tesla buyer is like the EV credits what's getting them over the hump. That's my 2 cents on that. But I think Tesla's focused more so on the other pieces of the business. And if you go back to the video, like they talked about humanoid robots, they talked about semi trucks, like that's a whole other area that's not even being focused on. So I would say it's not going to have as big of an impact. It's like the same thing with Rivian. You know, Rivian, it's like you're spending $90,000 on this thing. You know, you're probably, if you're the person that needs the $7,500 credit, you're probably not buying a Rivian in the first place. So that's what I would say. I think it's going to have more of an impact on like the lower end EVs. Thoughts on Oscar Snow Sound? Sound has gotten ahead of itself. I'm a fan of the company. It's going to get bought out at some point. Oh no, Braylon Allen has been ruled out for the rest of Monday's game against the Dolphins. Well, good thing he's on my bench. So Oscar, it's like health insurance, but online. health insurance is just like an awful business. And I know that's one that shows up all the frickin' time on YouTube. Everybody's asking about Oscar Health all the time. It's like it's a healthcare, like a health insurer that just offers health insurance plans online. It's like, so I don't see like what's so sexy about that. Snowflake has been on my radar for a long time, and it's actually coming back all of a sudden. Okay, it says, yeah, okay, I could see the AI piece with Snowflake. Snowflake's gone kind of sideways for a long time. I've been a fan of Snowflake, but then been like totally disappointed at it, like not doing anything for a very long period of time. I'd have to pop back into Snowflake. I'm positive on Snowflake in terms of the company and the business model. Oscar, not really a big fan. Sound I'm a fan, but it's ahead of itself. So I would wait for that to come back down. Dun dun dun. Hello. Um, would you invest in real estate in this market? No. And is it an asset class you should buy or invest in? I'm a huge fan of real estate, big time. Okay. You could depreciate it, you can improve it. Think about a stock, right? Can you increase the stock's value? No, you cannot. With a real estate property, you could. You could invest in it and increase its value. You could rent it out for more and increase its value. You also get depreciation, which serves as a tax shield. So there's like so many benefits structurally with real estate. But right now, I mean, in the New York, New Jersey area, it's just ridiculous. It's insane. So, I mean, there's pockets perhaps, but I still think it's too inflated. I would say at some point more supply is going to come on. When that happens, then it could be interesting. But I'm a fan of like old school real estate investing, like buy a multifamily, live in one unit, rent out the rest, like house hacking. I'd even consider buying like a mixed use commercial property and do the same thing, like live in one of the units and then rent out the rest. um, but I would hold off on real estate for a bit. I do have, full disclosure, Fundrise. I don't know, you guys might be familiar with this Fundrise. So it's private real estate, private. So I like that because you remove the beta, the volatility aspect. So I like that. Um, but this is cool. It's preferred. So Ori was asking earlier about credit investing. So this is a preferred position in the cap structure of real estate. So it's the credit side of real estate. This is something I'm a huge fan of. So think of like a project and you're providing like bridge financing. So you have preferential treatment in terms of the cap stack. That's something I think is cool. You don't have to be an accredited investor for it. I'm trying to open the app real time. You don't have to be an accredited investor to get into it, but you get more options if you are an accredited investor. Accredited investor, you have to have more than 200,000 in the last 2 years of income if you're single, 300,000 or more married, and then or $1 million net worth. It's much easier to prove the income than the net worth one. So this is considered private credit. It pays a dividend. It's like an 8% return. So it's a hedge more than anything. Yeah, annual. Oh no, this is the distribution rate, 7.73%. Yeah, so that's the other thing too. It's got like a nice distribution rate. I just reinvest all the dividends, but that's the primary way that I invest in real estate because like I look all the time. I'm a broker, so I've got access to the MLS and everything. People are just out of their minds. Like everything is just so overpriced. It's ridiculous. Let's see. BN views its AI infrastructure as the new railroads. I could see that. Data centers and power generation also has 51% stake in Westinghouse. I like this. Aims to triple its insurance AUM by 2029. This is getting very interesting. 100 bagger. Tilray. So I have a whole story about Tilray. Terrible numbers. U.S. plan on rescheduling. I'll tell you about Tilray in a sec. Trump posted a video on CBD, which is why Tilray popped. So Tilray, let me cover Tilray first, which is like a total like snake oil garbage opportunity. So during COVID, one of my buddies has a place down in Florida, in the Florida Keys, and he always like knows someone comes into his orbit who like has like an idea, like something to invest in. So he talks about Tilray. And you can go back, look back at during COVID, the thing just like ripped. So like he's like, yeah, this guy's made so much money on it. Da 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 da. It's like there's an old saying: Las Vegas wasn't built on winners, right? It was built on losers. So I'm always leery when someone's like, yeah, I picked this one stock, I made so much money. It's like, all right, give me two or three. It's like, well, I gave you one. It's like, yeah, no, give me more. I got that one. I heard what you said. So like this guy was like talking about that. It's like, oh, he's a genius. He's a Wall Street guy. Blah, 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 blah. And then like freaking like the thing cratered. And I'm going to be honest. I was a little joyous, not nice, but I was a little joyous when it happened because I was like, absolutely like no way. I looked at the financials. I was like, dude, this thing's a total dog. Now, what you did talk about here. So Tilray, no way. But the other one, BN, let me pull that up. So BN. And I'll share it. BN. Ah. So you are the one that's been asking about Brookfield. Aha. See, the problem is there's like 10 Brookfield tickers. So I'm assuming the BN one is the one that we should be referring to. I'm hoping. Assuming. All right. So you said they have a 51% interest in Westinghouse. They got a whole bunch of other stuff. Like whenever I hear Brookfield, I think real estate. Like I think REIT. And that's the one thing that we have to be very careful with, friends. We talked about this last time. You have to be careful with the structure. Anytime you have something that's an LP or a limited partnership structure, has major potential tax implications. Only invest in a non-taxable account. Otherwise, you could get absolutely eviscerated. Let's look at the long business description. Okay. Global asset management company, property, power, infrastructure assets, power generation business concentrated on hydroelectric. They have timberland. Infrastructure includes electricity transmission systems in Canada and Chile. They have office, they have residential. This is very interesting. Let's see the CIQ estimates. All right, it has an outperform rating. Not well covered, but it does have an outperform rating. What was the close? US dollar, 69.14. Okay, median is 73.61. This is the type of analysis that you would have to like do like a crazy deep dive where you would have to like do a legit sum of the parts. Yeah, see if you look at the metrics that are reported, FFO is funds from operations. So this is 100% like a REIT construct. So if you look down bottom, it says income trusts, distributable cash. So the only thing to be very, very, very careful with this type of business is exactly what I'm referring to here, the structure. So my guess slash fear is that they are structured as an LP, a limited partnership. And that's where you have to be like super careful. So let me go back to the long business description. Residential properties, retail property. I mean, they're all over the place. Holy Moses. Yeah, so this is the one I'm familiar with. U.S. residential operations are conducted through its 53% owned subsidiary Brookfield Homes, which, by the way, I think is also publicly traded. They have retail, infrastructure development, power generating operations, transmission infrastructure, specialty investment funds. Man, they're all over the place. Holy Moses. Private equity. Why not? They are all over the place. See, the other problem with a company like this, and we're looking at Brookfield, folks, um, oftentimes it's very difficult for the market to value an entity like this because this is like an old school classic conglomerate, like 100% classic conglomerate. I don't know why it keeps going back to this, but now I figured it out. Muhaha. So dude, that would require like a massive deep dive. That would require like really going hardcore, looking at the individual parts, like literally doing a sum of parts analysis and valuing each of the pieces. That's a slog. It's definitely one that would be, if you like analysis, it's definitely one to dig into, but that's one that would take like a month. I'm not being like facetious, like to really understand, it would take like a month to break that down into the component parts. But oftentimes, again, the market has a difficult time valuing businesses like that because it's all in the structuring. So that one's interesting. I'll have to like step back and like get out the scalpel and dig into that. But that one's interesting. Um, let's see. I want to get into real estate, but feel like I have a long way to go. So again, I'm not making anything from this. You could look at Fundrise, like FUNDRISE, and you could invest in real estate without having to do like crazy due diligence and termites. What do they say? Termites, toilets, and tenants. You won't have to deal with that. So if you just want exposure in your portfolio to real estate, that's how you would do it. What's your latest take and price target for year end? This one seems to have a solid product, good reputation, less famous and sold in Tesla and burning cash. But is it a buy right now? I apologize, Pete. I got to go back to your previous comment. Hold on. Okay, Cody, BN is not an LP. That is good. That is really good, actually. Oh, I'm sorry, Pete. You're probably talking about Tesla. The last time, just give me one sec. The last time I looked at Tesla, I could give you what we had. Obviously, I have to update it. But again, Tesla was another one that, I do the video, like someone had like a negative comment because it's Elon Musk. So there was still like the afterglow of like his involvement with the administration. So he like this guy had like an episode. He's like, "Oh, could you do this video?" I was like, "Bro, it's numbers. Take a chill pill. What the hell?" So I just opened up my model. The bull case that I had was 473. So that was the bull case. So we are approaching the bull, friends. Rivian. Wah, wah, wah. Yeah, Rivian wasn't like crazy upside. It was at a discount. And I noticed that one's been like trickling up recently. So just give me a sec. I have to see what it closed at. Because that one, I just kind of like noticed out of the corner of my eye. I was like, oh, what's going on with Rivian here? Yeah, so Rivian closed at 1525. I had 1626, but my bull is 24. So I don't see it getting there. But it could definitely approach fair value, 1650-ish, I would say. I could see that as very realistic. I apologize. I'm trying to manage this stupid comment bar. And there's like a very thin scroll bar. So you have to like grab it. Like, I don't know if when you were a kid, you played that game Operation where you grab the little pieces and you're trying to like pull the stuff out without it buzzing. That's what I feel like right now going through these comments. Jeff, you made it. What's up, man? Do you mind doing your take on SMR? NuScale Power. Oh, yeah. You were asking about that. I'll pull that up in a second. I have money. I will owe taxes next year. I was wondering if it would be smart parking it in Verizon since the price goes nowhere. That is accurate. And for the 6% dividend, just collect till the time comes to sell. Yeah, Verizon, for whatever reason, just never seems to move. Although I was looking at it, ironically, with my class, because I use it as an example, and AT&T like went on a frickin' tear, and Comcast crapped the bed. So, Verizon's one of those companies that always shows up as a discount, but just kind of like goes nowhere. So yeah, you could collect the dividend. Um, that's one way of looking at it. But on the same token, you could look at, some other higher quality options where you could get some growth upside. But I see what you're saying. Like, you're like, I want to limit or mitigate my downside. Verizon's pretty safe, but yeah, you're 100% right. It's probably not likely to go far. All right. Oh, ha. Can you check on BBWI and Cap IQ? Because I'm way too bullish on it. Do the analysts even agree with the $40 price target? Okay, let's see. This is like a stereotypical value investment. BBWI. BBWI. Bath and Body Works. CIQ estimates. Median is 40, low 32, high 62. So 40 is right on the nose. Yeah, so you're not crazy. And it got a 1.69 outperform, and 15 analysts cover it. So if you have a value of 40, you are in good company, because they are 100% in agreement. And it looks like they must be buying back shares because the EPS is going up, even though the revenues seem to kind of be not so much. That's one of those interesting, like, old school scenarios where it's like, it's a retailer, people, still go there. They got a big presence in malls. So yeah, 40 still it. All right. So we have confirmed, friends, Brookfield is not an LP, which is very important because that can cause major tax implications. I know this for multiple reasons. One, because it happened to me. Like, I remember my account was like, what the hell's all this stuff that you own? I owned like a bunch of BDCs and LPs. I got really bored during COVID, probably like the rest of you. And like, I was like, oh, this is undervalued. This is undervalued. And then he was like, what the hell? He's like, this is the worst thing you could ever invest in an account where you actually pay taxes. I was like, okay, good to know. Yeah, man, my pleasure. Damn. 19% annualized return for the last 30 years. That's insane. That's really good. Yeah, actually, I think all good. Yeah, no, dude, I appreciate you being here. But that might be one you could consider as BN over Verizon. I know Cody would be a fan of that. Thoughts on QBTS? It has had insane growth lately. So this is one of the ones that like people have been like, oh, you got to check this out. And then I'm like, what the heck is going on here? Oh yeah, this is a quantum computing company. So let's take a look. The stock price, 25.31. It is covered by 10 analysts. So that's a decent amount of coverage. The median is 21. Now it does have a buy rating, I think, because of like the trend that is quantum computing. And the revenue growth path is insane. But here's the problem. Negative EBITDA. Dude, negative EBITDA, like, unless and until you can turn that positive, there's literally no value. It would almost be like if you said, hey, Ken, I'm thinking of IPOing. Am I not showing this? Sorry. I'm so excited on it. I forgot to share my screen. Lo siento, friends. Here it is. So QBTS. So we've got latest price, 25.31. Median is 21. So it has a buy rating. It's covered by 10, but it's overvalued by $4 there. But this was the point I was trying to make. And then I realized I wasn't sharing my screen. Revenue growth is insane. Look at this. Whoa. But here's the bigger problem. It's not the revenues. I'm going to like sound like my videos. Revenue is what you make, net income is what you keep. Well, that's assuming that you have positive EBITDA, because you're definitely not going to have net income if you don't have positive EBITDA. So, like, real talk, a company will have no intrinsic value if it has negative EBITDA. Not only does it have negative EBITDA, it's not getting like better, it's actually getting worse over time. It's becoming more negative. So, what do I think? Stay away, because unless and until it turns EBITDA positive, it literally has no value. Now, I know what you're saying. Like, what do you mean, Ken? Like, there's 10 analysts that cover it. They have a value of 21 on it. Like, all the value is in the terminal value, which means like whenever their model ends, let's say 2029, I would venture to say they're probably putting a revenue multiple on it. And it's like every company has revenue, unless you're Archer Aviation, of course. Um, but you'd really want to do a multiple, if possible, off of EBITDA, because that's a proxy for cash flow. And negative and increasingly negative EBITDA is definitely not good. So that's my take on that. Hopefully I didn't disappoint, but yeah, that's the thing. Some of these stocks just like go on a tear, and they're kind of like memeish. Um, oh no, Jeff's having PTSD. He had it at 5 and sold it at 10. The quantum stocks in general are just kind of running bananas. It's a thematic play. It's like any company that has like .ai past it. It's like dog poop .ai. It's like, have you seen dog poop recently? It's all over the place. It's like, oh yeah. So like they don't even have to have a business model or anything. It's very reminiscent of like the internet bubble in the late 90s. I was like a little kid, and I vividly remember we were at like my uncle's house for Christmas, and like my whole family was like blue collar, like plumbers, landscapers, stuff like that, and everybody's talking about stocks. So I turned to my dad. I'm like, "Are these guys like stockbrokers or something?" He's like, "No." He's like, "That guy's a plumber, that guy's an electrician, that guy's a landscaper." I'm like, "What's going on with the stocks?" So everybody's talking about stocks because they're making so much money in stocks. Know nothing about stocks, by the way. And then the next year, everybody like there was no talk about stocks. I turned to my dad. I was like, they're not talking about stocks. He's like, shh. Like everybody lost their shirt, like lost everything. So it kind of reminds me of that with quantum computing. Oh, so we're going back to Bath and Body Works. Yeah, buying back stock, going international or franchising. Yeah, anytime. That's what I'm here for. Um, yeah. I mean, look, I would be very cautious about going all in on any of these things. You know, yeah, so total momentum play, and it's musical chairs. And like you might be in the bathroom when the music stops, and you come out and you're like, where'd everybody go? There's no chairs anymore. It's like everything's gone. Um, I don't even know. Like that's the type of thing that like you would do via options, perhaps. Like if you really wanted to get some sick return, that would be the way to play it. But I mean, honestly, like I'm talking about play. Like I'm not talking about from like any investing perspective. Um, you buy call options on it and trade it. That's no, that's so um so there's very few examples of no-brainers in life. Um, Again, it has negative EBITDA, dude. It's like if I told you like, "Hey, I've got this business." You're like, "Tell me about it." I'm like, "It's making money like crazy." You're like, "Oh, like what is it making?" I'm like, "Well, I'm not actually like making money, but I'm getting lots of revenue." You're like, "Oh, what are you making?" I'm like, "Oh, I'm losing money like crazy, like hundreds of thousands of dollars." They're like, "Do you want to invest?" Like, you might invest because it's me, which I would think would be very nice of you, but it's not a good investment. Um, but yeah, you got to be like super careful with those. Like you could literally play it with options, but that would be like the only way I would get exposure to something like that. With so many electric cars on the road, I need to know where you live. There needs to be solutions to discard all of these freaking lithium ions that are going to be of no use someday. Any company working on a solution to this? Yes, I was mentioning it earlier. It was before you arrived, Pete. Is it Lee Cycle? Lee Cycle, which Now I just realized, I'm not even joking, lithium ion recycling. I just realized that was the whole connection there. LIC. Yeah, they're already they're already gonzo. They're out. See, this is what I'm talking about. They were a little too early. Yeah, Lee Cycle was the company, dude. That was the answer. So like their whole business model was built on recycling batteries. Um, and now they are no more. Sorry, Lee Cycle. So there we go. Yeah, Jeff. Plug in Celsius. I like that. Hold on. Leon, you're new and young to this whole thing. I literally was having a conversation about this earlier. Like, the first person who came in the chat was talking about, like, what should I invest in for the next 10 years? That's the right question to ask. Like, if you're approaching this like Wall Street bets and like, like YOLO, it's not going to end well. You want to focus on building that foundation that's going to compound for a long period of time, like VOO. So yeah, Jeff was referring to Celsius, the energy drink maker. It's still at a 20% discount based on my valuation. I got 70, so 58.33 is a 20% discount. But like, Leon, I'll give you homework. Just go back and watch like all my videos, and that should hopefully make sense. You could go back and look at the Celsius video, look at the SOFI video, go back and look at the CrowdStrike video, which ironically I was in the process of updating and then that thing ripped. So I was like, well, there goes the discount there. Yeah, I would say focus on those, because if you're just kind of like grasping at straws, trying to find the next thing that's going to pop, it's going to be tough. Oh, nice, Pete. Yeah, New York, New Jersey. Sweet. Yeah. Oh, you do have an EV. Okay, so there's like a genesis to the questions. Okay, I get it. Yeah, I mean, I see like more EVs where I am too. I was figuring maybe you were like in like a city. Um, yeah, it's a legitimate concern, like all kidding aside. So you can have an EV in our area, but like if you go further west, like this weekend, fun fact, I was in West Virginia. I split season tickets with a buddy of mine because he is a West Virginia alum. And we thought Rich Rodriguez, the return, this would be like, the season to get tickets, not this season. But dude, if you go out that way, there's no way you could have an electric vehicle. 0% chance. Zero. My cousins live in Indiana. It's like hard pressed having a gas powered vehicle out there. There's like no freaking infrastructure, and it's flat as a board. You look any which way, you could see for like hundreds of miles. I remember. So funny story. I was out visiting my cousins in Indiana. I was like, we got to take cover. And he's like, why? I'm like, there's a tornado. And so like, if you looked in the distance, there was a tornado, and he just starts dying laughing. I'm like, dude, there's nothing funny about this. Have you ever seen those like tornado chasers? Like, we're in trouble. So he like can't stop laughing. I'm like, what's so funny? He's like, that tornado. I'm like, yeah, that one right there. You can see it. And he's like, that's probably like 300 miles away. And I was like, oh, we're good then. Yeah. So like out there, there's like nothing. I mean, it's like barren. But yeah, you could totally rock an EV in our area, the New York, New Jersey area. Although I have a very good friend who has a Tesla. She's in New York City, and she like complains because like she has to drive out of the city just to find a charger. So she was telling me like she has to drive, like 45 minutes to an hour just to like charge her vehicle. So she drives outside of the New York City to charge her vehicle and then comes back. All good, man. It's good seeing you. Thanks for popping in. Don't be sad. We do this every week. We all meet together. Yeah, see? Good man, Jeff. Not financial advice. We don't give financial advice here, okay? All right, so this is good. Yeah, and this is another good piece of advice. So it seems Leon's a little wet behind the ears. Jeff, I am also biased like you. I actually like the product. I like every time I go to the grocery store, I get Celsius. Watermelon's my jam. That one's mine. Like, say what you want. Watermelon's my absolute favorite. I could like guzzle that stuff. But I do have to be careful because like if I just start crushing Celsius, like it doesn't go to a good place. I start talking even faster than I normally do. Um, but yeah, I genuinely like the product. And also, I don't know, Jeff, since you are a Celsius fan, I've been noticing a lot more Alani Nu everywhere I go. Now, part of it is because like it's on my radar because of, Celsius. But no joke, I told you guys I was out in West Virginia. Alani Nu everywhere, like every freaking flavor too. They actually had a better selection of Alani Nu than I do at the grocery store in New Jersey. Seriously. Now again, college town, so maybe it was like that factor, but I actually like genuinely enjoy the product. Like in terms of energy drink options, tastes good. Dragon fruit, yeah. So I did the what did I have? The cherry slush. Um, Dragon fruit lime. All right, now I'm gonna like. I know what's gonna happen. I'm gonna go to the grocery store tomorrow, and they're not gonna have it, and that's the one that I want to try. Um, but like, it's always easy to find the cherry slush and then the orange one. Those are easy to find. The cherry slush is really good. I like that a lot. But I'm gonna have to do the dragon fruit lime. All right, cool. It's on the to-do list, y'all. Definitely gonna rock that. Um, but yeah, so Leon, all kidding aside, so Leon mentioned that he's kind of like starting out with investing. You got to look back at the old videos. I think that would be super helpful for you. You know, this is definitely not like trading focused, it's more investing focused. Um, so I would say go back, look at some of the videos. You could see from the results, CrowdStrike's over 100% return. SoFi, SoundHound, there's a bunch of them. Even, Microsoft, I was saying buy when it was at 360 and then it popped to 550. So how often do I stream? Every Monday, 7 p.m. Eastern Standard Time. So every week. So you miss out. But yeah, check out the videos and then give some feedback. That would be the take, ask questions. That's pretty much what we do all the time here. Ha. Yeah, Costco is definitely the way to go. Yeah, Alani Nu, like I needed it on my way back from West Virginia. It was a 6-hour drive. So I needed something where I was just gonna be like, whoa. So that's what I was going for there. Trying to rock the energy. I apologize. I got my fantasy app updating me. My fantasy team's horrible this year. Tyreek Hill is down, and that didn't look good. Dolphins and Jets player reactions as the cart comes out tells the story. Well, good thing he's not on my fantasy team. Although I do feel bad for him. I don't want to see anybody get injured unless they're playing my team. Ooh, that's a good idea, Jeff. Best time to listen to Ken's during the gym. Headphone plugged in, workout jams to Ken's video. I like that. I don't know if I would work out to my videos though. I'm usually listening to metal, but I could see that. I mean, maybe if I was going for like a run or something. Yeah. What's the next Celsius? So here's the thing. My big challenge here, and I was lamenting about this earlier, like once we have 100,000 subscribers on this channel, I will literally do like the most like companies that you've never heard of in your entire life. You're like, how'd you find this? I'll be like, I'll tell you later. But right now I'm in this weird spot. So if I do Microsoft like I did last week, it's like I might as well have thrown that in the Grand Canyon. Nobody cares. Second largest company on planet Earth. It's actually at a discount and it's a great investment, but nobody cares. Nobody's searching for Microsoft. They're searching for qubits. Then I'll do like some like obscure name and nobody's searching for that, so that doesn't show up. So it's like I'm in this like weird spot. At least if I had 100,000 subs and I got 10% of the people to watch whatever I produce, that's 10,000 views. The algorithm will pick that up and run with it. But right now I'm like stuck having to do like, meme type things in order to get some like buy-in. Like, because you're all here and I obviously love you as my subscribers, this week I'm working on it right now. Super micro. I had to go back to the well because that's going to perform well. People are searching it. Am I a fan of the company? Not at all. The accounting is horrible. Really not much in terms of competitive advantage, to be quite honest with you. There's other companies that do like the exact same thing, but everybody wants to see it. So it's like, that's what I'll do. Oh, you're in Europe. Greetings. Oh boy. Hopefully you got in at a good price there. I don't know how long I'd be holding that Intel for. Ooh, how do you handle the long hours that IB demands? Definitely have something to listen to while you're working, or else you'll lose your mind. That's one thing. Also, have something to look forward to, or you will also lose your mind. I always advise have a vacation planned every 6 months. No matter how bad things get, and investment banking, they could get pretty bad. Like, you're working on a Saturday night at 2 o'clock in the morning, not fun. If like you're going on vacation to like St. Martin in 6 months, you can endure all sorts of awfulness. That's my advice. Also, I'm like a vat of like useless information. So just giving you a heads up. They've done studies on the happiest people on earth. Okay. So Denmark usually wins like the happiest country on earth. And it's usually Scandinavian countries in general. But what they did was they were like, what makes them so happy? And I'm not talking about blue zones, longevity stuff. It's like, why are you happy? What they actually found was there's an optimal amount of free time that you can have per day for optimal happiness. And it's actually 2.5 hours. So 2.5 hours of totally unstructured time. Do whatever you want during that time. Like, that is maximal happiness. So if you could structure it like an hour in the morning and an hour and a half in the evening, now it might mean waking up earlier or going to bed later. That is how you can kind of maximize your happiness, but always having something to look forward to. If you don't have something to look forward to, it's brutal. It's absolutely brutal. But that's what I would advise doing. But the problem is, like, you have to be like militantly protective about your vacation, like, because they'll try to blow up your vacation. Just be like, no, I'm going. What got you into sitting for CFA versus CFP? Good question. So I was on the hedge fund side. So I wasn't interested in like the total financial picture. We actually had someone in our firm that was more like the CFP side, focusing on that. I was just more interested in stocks and investments. But, there's a taxation piece to it. It is interesting, like structuring, trusts, all of that stuff. Like, it is very interesting stuff. But I kind of look like at that as like you find out the answer and then you implement it. It's like, okay. Whereas with stocks, it's like there's always something new, there's always something to learn. But the CFA, like if you want to run money and have a fund of your own, the CFA is the gold standard. I looked a few weeks ago. I think there's 250,000 CFA charter holders on Earth, and there's 8.142 billion people. So there's actually more doctors in the United States than there are CFA charter holders on Earth. It was like some ridiculous number. It was like 0.0013%. So it's pretty exclusive in that regard. But it was more so like the end focus. There's a lot of stuff with the CFP that just wasn't really interesting to me because it's like, optimal tax strategy. It's like, okay, once you know it, it's like there's nothing new with it. But that's why I was more focused on CFA over CFP. Like, full disclosure, I do not want to be Susie Orman or Dave Ramsey. Like, if I had to like be on this live stream and do like a Dave Ramsey and be like, so tell me about your financial situation. The person's like, I have $1.5 million of debt. I'd be like, okay. Like, how'd you get into $1.5 million of debt, dude? What the hell happened there? You know, like those are not the people I want to deal with, you know, at all. But yeah, the CFA is a beast of an exam, dude. Absolute beast. It's like over 3,000 pages of material, 6-hour exam. Um, it's literally like taking one test for every class that you took in college. Like that's the only way I can really articulate it. But definitely worth it. Definitely worth it. It's looked at as the gold standard. In fact, I was on a conference call about a private equity investment, and there was a guy who was like on the call first. He was a CPA, and then I got on the call. You know, Ken Freeman, CFA, and all these people got on the call, and the guy was like, CFA, wow. And he just started like going off on that. And most people didn't even know like what a CFA was. But this guy, he's like, I have a CPA. That's like a joke compared to the CFA. That's impressive. And like, I'm meeting all these people for the first time. So like, I don't know anybody. And this guy is just like going bonkers on this. I was like, yep, cool. Thanks. So people know it's like insanely difficult, but it's definitely worth it. The problem is like, you know, you get older, marriage, kids, the whole 9 yards. I have none of that. So like I had the time to be able to study. But like if you have those responsibilities, like I just don't know like how you would do it. You know, 300 hours to pass the exam, like how do you cram that into life? Like it's just insane. Ah. Mm-mm. Hold on, we've got a new comment here. Trying to break into SCM. How often did you rub shoulders with that industry? So I'm always curious. SCM. I apologize. Like that's not an acronym that I know. SCM, something management, supply chain management. Never rub shoulders with supply chain management people at all, ever. Now, what I will tell you, and this is not just a shameless plug, Rutgers, where I am a professor, that has like one of the best supply chain management programs on earth. Um, Personally, I think it's kind of like boring. I get it. Like, you know, we need to have inventory, we need to collect our receivables, we need to pay our payables. But it just like wasn't interesting to me. So I don't personally rub shoulders with people in that industry, but I can tell you like Rutgers is like beast when it comes to supply chain management. So something to consider. Something to consider. Yeah, yeah, Jeff. Jeff figured it out way before me. Yeah, SCM, supply chain management. Um, just read some articles on Intel. Thank God I had the ability to cancel the transaction. Yeah, this is like with qubits and all this stuff. It's like it pops. Like I saw Intel was at like 35. I was like, holy moly. Talk about something that's way ahead of its skis. Like, oh my gosh. Thoughts on Nike earnings tomorrow. So I'm curious. I actually one of my former students slash good buddies slash um, coaching clients slash little brother actually covers Nike. So I'm going to see what he thinks about it. So I'm curious. I'm curious. Um, I mean, it's sad. Like I think Rutgers might have surpassed Michigan State for a very short time. Um, but dude, like I don't want to go on a tangent on this, but like to lose to Iowa the way that they did and then lose to Minnesota the way that they did, it's like there's no hope now. And here's the thing. I don't know what kind of masochist scheduled this. Our homecoming game is against Oregon. Now, usually, like the homecoming game is like kind of a slam dunk, like you're gonna win, everybody comes back, you know, da 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 da. Oregon? What? We still have Oregon, Ohio State, and Penn State. Not good. There's like right now, there's like a 0.0% chance of us making a bowl game, and I'm rounding up. You had to win. You had to win the Iowa and Michigan State games. Like, just totally stupid. Ugh, so frustrating. But I'm also a Notre Dame fan. That's actually like my primary team, even though I didn't go there. It's one of those teams like growing up, just a huge fan of, and like massive frustration there. It's like season's over already. And it's like, oh, well, they did well against Arkansas. It's like, it doesn't matter. It's too late. You know, I mean, the good news is the two teams they lost to by a total of 4 points are Miami and Texas A&M are doing well, but their whole schedule's garbage. So it's over. So like, you know, they'll make a bowl game, but who cares? And then Rutgers, they're not making a bowl game. Not happening. All right, guys. I had to see where my fantasy team is at. It's probably not in such great shape. Good God. It's 7-3 Denver, Cincinnati. So I've got Jamar Chase and Chase Brown. Both of those guys have been like career worsts in terms of performance. So I'm going to have to go see that disaster. Um, yeah, Nike's one that's been on my radar. It just has to have the search juice. For this week, I'm actually going to do Super Micro because that has the search juice. So that's one that like will actually get views. But that's one I'm looking at. Oh, sweet. Awesome. Just discovered a couple days ago. Oh, man. Sweet. Yeah, Amazon, PayPal. Yeah, so we got Super Micro coming out this week. Yeah, Celsius, that was a classic. We were talking about Celsius earlier. That was a big one. That was a good call when it was down in the 20s and everybody was leaving it for dead. I was like, might be a good one here. But it's actually still at a discount, which is kind of crazy. Top 3 long-term 5-year hold outside of Tesla, HHH, and your favorite Joby. Joby's just such an anomaly. It like flies in the face of everything that I preach on the channel. Top 3 long-term outside of Tesla, HHH. Dude, no joke. Microsoft, 100%. Not even question, not even joking. Microsoft's going to win with AI. No doubt in my mind. Microsoft is going to be the big winner in AI, like more so than anyone. The research that I did for that video, I was like blown away. You know, when people are talking about, oh yeah, we're building data centers, it's like, oh, okay, that's great. And it's like, yeah, it's going to be open in 2026. It's like, oh, the end of 2026? It's like, no, like a few months. Like my brain almost exploded. The Fairwater data center, which is going to be in Wisconsin, 100,000 NVIDIA GPUs in one building. What? Like, huh? So I'm just opening up the old portfolio. So Microsoft, I would put long-term hold. It ran up. I have to look at it again, but CrowdStrike, that's an interesting one. Meta, if you can get it cheap. I would say Meta if you could get it cheap. And honestly, we talked about this last week. I need to update. This is another one. Like I do this video, it's going to be like throwing a brick into the Grand Canyon. MasterCard. Visa and MasterCard are like the closest thing to a cash machine that exists in the stock market. They have a duopoly. They own 90%, 90%. It's literally trillions of dollars that they dominate. I mean, like, no joke, open your wallet right now. I bet you have a Visa, a MasterCard, or both. And I know I have both for a fact. So, total no-brainer there. So, I would say Microsoft, take your pick, MasterCard or Visa, because they just, like, freaking dominate, like, absolutely dominate the space. And then a third one, 5 year. I think Rivian will be able to figure it out in 5 years. Meta, if you could get it cheap enough, I would do, because they like the returns on that company are just like absolutely insane. So those would be my my picks, Pete. Those would be my picks. 100%. Oh, the Restoration Hardware. We're back on that. So yeah, Microsoft's still at a discount, just barely. Oh boy, Microsoft partnered with MBIS. Yeah, we'll just throw it in. Throw it in. You know what? It's funny because I apologize. I needed to do a deeper dive to give you an opinion on NBIS, but I'll pull it up here so that we can say that we looked at NBIS. But this is another one. This is NBIS is like a qubits, but they actually have some good partnerships because they got Microsoft as a partnership as well as NVIDIA. So stock 110, median 130. So it's still a decent discount, 1.5 buy rating. It's only covered by 5, but again, looking at the financials here, wait for it. All right, positive EBITDA in 2026. So that's the key. That's the hallmark. And then positive EBIT in 2028. All right. So that's what they're going to need. They need to have those because like if you don't have that, you don't have value. You have to have positive EBITDA to have value. So it looks like they'll get it, EBITDA 26 and then 28, 29. I mean, just look at the revenue growth path. It's like almost laughable. You got 576 in 2025. Then it almost triples here. And then it almost triples again. And then it's like 2.5x here. I mean, it's just like when you get to this level of growth, it's like clown college. It's just like so ridiculous. Like you can't even begin. It's just like bananas. So that's our old pal Nebius. I'm actually curious because I want to see what the recent chart looks like for this because I remember it was just like vertical. Let's see, annotated stock chart on Nebius. Yeah, ba-boom, badonk. Yeah, this was the one that I remember I saw it. I think you were like, hey, you should check out Nebius. And then it was just like, poof. And it was like, whoops, oh, there it goes. Goodbye. So yeah, there's Nebius. It's like, it's impossible to value companies like that, though. That's the thing. I don't know why this still goes back to this. It's so freaking annoying. Oh, you were asking about Fiserv. I apologize, Ajit. I'm a fan of Fiserv. I don't know if I looked it up last time. Fiserv, we actually owned when I was at the hedge fund years ago. That great company. It got bought out and then it got went public. Down to Chinatown. All right, let's see the CIQ estimates. Again, this is Fiserv, which stands for Financial Services. 130. The median's 182. Okay, so it's definitely at a 20% discount. Looks like a 30% discount. Decent growth. Positive EBITDA for sure. I'm actually curious, what's their debt? Yeah, highly levered. 26 billion of net debt. So debt less cash. So it's a pretty levered entity. Well, relative EBITDA 2.6 times. But I have to dig into that more. That's one, I'm going to add that to my list. I'm sorry about that, Ajit, because I remember you asked about that previously. I'm always looking for stocks to check out for you guys. Yeah, let's pop it up. Is Meta a good buy right now? Not right now. SMR. Yes, let's do it. Let's do it. We'll do it live. We'll do it live. If you know the reference, if you know, you know. SMR. Come on, NuScale. Dude. 38.16. Nah, 40. 5% discount. It's got an outperform rating. But let's look at the numbers, friends. Let's look at the numbers. Map. Dude, you are like unearthing the negative EBITDA companies. Yeah. Put it at 0, dude. Unless I have positive EBITDA, no value there. So stay away from that. But I know when I look at the tear sheet, it's going to be, small module reactor tech. So yes, this will definitely be needed. Water reactor can generate 77 megawatts. Company was founded in 2007. So small modular reactor technology. So it's like They help with nuclear technology. This is one, yeah, this is one I would take like a flyer on. It's probably like when you look at the historical numbers, it's probably not going to show up as a value, but I'm going to add that with Fiserv there. Um, yes, all right. So you do remember it. Do it live. Classic. If you don't know the reference, I would advise like checking it out. Like we'll do it live. And in fact, one of my favorites is when Stewie from Family Guy did the do it live. That like you will fall off the chair and die laughing. Cake. I like eating it. So let's see. I haven't looked at cake in a while. Food. Comes up as a hold. Here, I'll share my screen. Cake's another one of those ones where it's like the competitive advantage of it. Like, I like going there. They give you way too much food, which I'm always a fan of. But numbers wise, businesses like this have been struggling. I mean, look, there's not much in terms of growth here. 3765, 3994, very inventory intensive business. I mean, there's just no growth here. That's the whole thing. This is like a classic value investing scenario. But, it's at a discount, 67 for the median, 55.50. But this is like the type of stock that'll take like, 5 years to get to its intrinsic value because there's no like catalyst really. But that would be like a stereotypical value investment where it's like it's undervalued, but it's like there's no catalyst. It's never going to achieve fair value for like ever. Yeah. So what do you think about the market being richly valued? Schiller PE, total United States stock market, high, blah, 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 all this combined with weak job reports. So the Schiller PE ratio was kind of debunked a few years ago. And let me explain what I mean by that. So back in 2017, McKinsey did a study. If you remove the Mag 7, okay, remove the Mag 7 from the S&P, the actual PE ratio is at the historical Schiller PE, about 16 times. Right now, because the Mag 7 makes up 33% of the S&P 500, it inflates the multiple. So, there are people out there like Jeremy Grantham. You can go look him up. Jeremy Grantham, GMO Investors. He's been saying that the market's overvalued for literally the last 10 years. And he's looking at these types of metrics. Buffett looks at, I think it was the Wilshire 5,000 to GDP, same type of stuff. When you bring in technology companies that trade at very high multiples, it's apples and oranges, okay? And here's the thing. The Schiller PE ratio has been around for like 140 years. Think about what you're comparing to. You're comparing NVIDIA to a railroad. You're comparing Meta to a radio company, like literal radio station, like AM, FM radio. So the growth profile of these companies, it's like laughable. Like there were actually like 140 years ago, there were box companies that made boxes, like literally like a box, like a cardboard box. Like, oh my gosh, that box company, you invested in Box Corp? I mean, you're just like, what? It doesn't even seem real. But what's the growth trajectory of a box company? Like that's what you're comparing. So I wouldn't look at that to determine whether the market is under or overvalued. That being said, the economic reports and the jobs data and stuff like that is not really like vouching for the strength of the stock market. But again, like how are earnings for companies? That is key. And remember, the stock market is a leading economic indicator. So the stock market's telling us that the economy is going to be better going forward, not the other way around. So a lot of these other metrics are backwards looking. So that's where you have to be mindful. But if you look shadow unemployment, there's websites out there that say shadow unemployment is like 15%. But that's because the way that it's structured is after 18 months, you're off the roll. Like you don't count anymore. It doesn't necessarily mean you got a job, but you don't count in terms of the statistics anymore. But again, I'm not like, oh, the market's going to go down because it's gone up. No, now I will tell you, most companies are very fairly valued. There's very few discounts out there. I will give you that. There's very few discounts out there. So that's annoying. It's very hard to find companies that are trading at a discount. That's why, like, when I have one, I'm like, oh my gosh, this is amazing. So yes, I'm still bullish on the market. Oh yeah, TTD, you were telling me about that. Don't tell me it went on a tear, did it? Because we were talking about Webull earlier. That was another one that people were talking about. Uh-oh. Did I miss it? Yeah, geez. 5.3%. I'm on it. It's on the radar. I promise. What's the difference between a hold and a buy? Excellent question. So if a stock is trading at a premium, meaning you have a value of 95 and it's trading at 100, that means it's overvalued. You don't buy things that are overvalued. If it's between a 0 and 20% discount, so you have a stock that's at 100 and like the value's at 100 and it's trading 20% below that. So I think that'd be 84. That would be considered a buy. Anything that's 20% discount or greater. Anything in between, that is where it's considered a hold. So that would be the way to look at it. So 0 to 20% is a hold. Greater than 20% discount is a buy. Anything at a premium, you wouldn't pay more for something than it's worth. Michelle, we might just be at the beginning stages, though, of TTD. So you did tell me, and it is on the radar. And it does have good search juice. So it is something that would actually be worth it to do a video on. So there was that. There was Webull. Those are some of the ones that I've got on the radar for the future. All right. Apps, TTD. All right, friends. I need to cut it here. So I apologize, but we've been together for 2 hours and 22 minutes. So I'm going to bid you adieu. Don't forget to watch the video when it pops on Friday. Like, comment, share, pop that algorithm so we can get more subs. And then think of all your amazing questions for next week when we meet again at 7 p.m. Eastern Standard Time. And in the interim, I hope everybody has an amazing week. Take care, everybody.